Pro traders may use this risk-averse Ethereum options strategy to play the merge. Unfortunately, many novice traders tend to miss the mark when creating strategies to maximize gains on potential positive developments. For example, buying ETH derivatives contracts is a cheap and easy mechanism to maximize gains. The perpetual futures are often used to leverage positions, and one can easily increase profits fivefold. If the price of ETH drops 19% from the entry point, the leveraged buyer loses the entire investment. How pro traders play the risk reversal options strategy? Options trading presents opportunities for investors to protect their positions from steep price drops and even profit from increased volatility. Investors rely on the risk reversal options strategy to hedge losses from unexpected price swings. Then, the trader will sell 9 ETH put $1,700 options contracts to net the returns above this level. Finally, the trader should buy 10 call $2,200 options contracts for positive price exposure. Investors are protected from a price drop below $1,500. That option structure results in neither a gain nor a loss between $1,700 and $2,200, up 27%. Every investment and trading move involves risk,